Hi, I'm Monk and this is the Monk Way. It's time to take a closer look at marijuana stocks. With legalization coming in October in all of Canada, which of the two biggest marijuana companies should we invest in? I did a lot of research on both companies for a comparison. We'll look at Canopy Growth and Aurora Cannabis, see how much growing space each company will have and how much production per year, and what kind of partnerships did they establish. We'll also look at the numbers for a possible future valuation. Subscribe and hit that bell to keep updated on these companies. I'll make a new video on any huge news about weed stocks, and leave a like if you want more videos on marijuana stocks. Let's see how you can buy these companies before we look at them. As an American, you can buy Canopy Growth with the ticker symbol CGC, and ticker symbol WEED in Canada. Aurora might be harder to buy because they're only in Canada with the symbol ACB. They're available off the counter with the symbol ACBFF, if your brokerage allows it. Since Canopy moved to the New York Stock Exchange recently, Aurora could move over very soon. A little more info about marijuana. Marijuana will be legal recreationally and medically in all of Canada on October 17, 2018. There's an estimation of $5 billion annual revenue to be made in Canada, to as high as $10 billion a year. Keep in mind these companies also plan on supplying weed to the global market, which is estimated to be worth over $100 billion a year. But that's the best case scenario. There are laws not allowing supplies to go to America, which reduces this number by a huge chunk. It's also estimated by 2020, Canada will be producing more weed than it can sell, causing a drop in price per gram. At that point, the global market will be where the real money is. First, we'll do a quick comparison of their numbers. Since marijuana isn't legal yet, these numbers are not very important except to see if they might be overpriced in the future. Canopy has a market cap of $7.13 billion, Aurora is on $6.54 billion, 91% the size of Canopy. They used to be $3.88 billion or 54% the size of Canopy until they bought Medreleaf, increasing their market cap to $6.54 billion. This is important because we can get a future price to sales ratio using market cap. For example, if Canopy makes $3 billion a year, dividing 7.13 by 3, we get a price to sales ratio of 2.4, the average being 2.2. This would be a very fair value if they made $3 billion a year. No PE ratios because they're not profitable, mostly due to mass expansion for the future. Canopy has a price to sales of 91.47, extremely overpriced, and Aurora has a price to sales of 92.47. This means future revenue is priced in on both companies. Investors are expecting revenue to go up 10 times in the coming years. Price to book is looking a little better at 5.65 versus 2.79. Canopy has almost no debt, and Aurora has very low debt. In the past year, Canopy went up 266%, and Aurora is up 153%. Aurora really dropped in the recent weeks due to buying Medreleaf with their shares, causing shares to be worth less. Canopy is also down from its highest point, about the same price as the end of 2017. These numbers can't tell us much at this time. To really compare these stocks, we have to see which will be making more revenue. More revenue means more profits after costs, leading investors to raise the stock price. In theory, whichever company can grow more marijuana and have more partners to sell to, will be the winner. So let's see some stats on these companies, starting with Canopy. They have 74,000 patients using medical marijuana right now. These patients are already paying them and giving them revenue before legalization. They made $22.8 million in the past quarter, but a net loss of $61.5 million. $2.3 million was from Europe, or 12% of their weed sold revenue. They have 2.4 million square feet of growing space right now. They're expecting a total of 5.7 million square feet before the end of 2019. Not only that, but outside of Canada, they just bought a huge facility with over 4.5 million square feet in Latin America. This means they almost doubled their production space, once this new facility is complete by the end of 2019. Here's a list of their facilities. As you can see, British Columbia is expecting some huge greenhouses. An area of 500,000 square feet is GMP certified, meaning safe to sell in Europe. These will be completed in 2019. That's over 5 million square feet of weed growing space. They want to produce over 500,000 kilograms of weed a year using that space. At the current price of $8.43 per gram, that's $4.2 billion of revenue. This gives us a very good price to sales ratio of 1.8. Of course, that's the best case scenario, which is not likely. Price per gram will likely be lower, and they would need people to sell to. Right now, they have agreements to sell over 67,000 kilograms to these provinces, which is not close to 500,000. This includes New Brunswick, Quebec, Yukon, Manitoba, Alberta, British Columbia, and Newfoundland, meaning companies have agreed to buy 67,000 kilograms of their weed in the first year. Once legalization happens, Ontario, being one of the most populated provinces, is not yet counted, meaning they have more agreements coming up. Assuming Canopy can get at least 100,000 kilograms of sales per year, including medical patients and recreational sales, and let's say they get $5 per gram selling in bulk, or $5,000 per kilograms, that's $500 million for a year. Dividing $7.13 billion by $500 million, we get a price to sales ratio of 14.26. This is fairly high but more fair than 91 right now. As a comparison to some popular technology stocks, Facebook has a price to sales of 14, similar to Canopy if they sell 100,000 kilograms a year. Apple is closer to the average at 3.8, average being 2.2. Amazon is 4.6, Netflix is high at 12, and Google is 7.3. This price-to-sales ratio of 14 is pretty high, but some companies are around that level. Looking years ahead, sales should go up, especially when marijuana-infused drinks are created. Canopy partnered with an alcohol company called Constellation Brands, and they're likely to create these drinks in the future. The CEO talks of no-calorie drinks that relaxes you similar to alcohol, which can definitely be a new market. He also talks about medical trials using weed to find use for it as a sleep aid. Sleeping issues are common, so this would be a huge breakthrough. Growth might see 150,000 kilograms sold in 2019, then 200,000 kilograms in 2020. The upside isn't super high because these stocks are already overpriced, but there's still an upside in the long term. If the price to sales stay around 15, when 200,000 kilograms are sold, we could see the price double by that time. The current price of $32 might be $70 by 2020. The price can also go much higher, much sooner, if the market decides a higher price to sales ratio is fine too. Canopy is the slow and steady company of the two. Let's move on to Aurora Cannabis. They have been acquiring a number of marijuana companies, hoping for mass expansion in the future. They have 45,000 patients right now, giving them revenue before legalization. Last quarter, they made $16 million in revenue, at a loss of $19 million due to expansion, compared to $22.8 million from Canopy, at a loss of $61.5 million. After merging with Medreleaf, they have about 70,000 patients, the same as Canopy. An additional $12 million in revenue and more loss of $800,000, which puts them ahead of Canopy in terms of revenue. They have a similar amount of space, about 5 million square feet with Medreleaf, a production expectation of 570,000 kilograms a year. This means a higher production than Canopy, which expects 500,000 kilograms, very similar production numbers. Here's a list of their facilities. They're working on some huge facilities including Aurora Sky, an 800,000 square foot facility, making over 100,000 kilograms a year. Aurora Nordic, which is in Denmark, a 1 million square foot place making over 120,000 kilograms a year. Aurora Sun, 1.2 million square foot, making over 150,000 kilograms per year, and a few smaller facilities as well. And after buying Medreleaf, they have a new facility making over 100,000 kilograms a year. Their current supply agreements are not as good as Canopy's 67,000. They have an agreement in Alberta for 25,000 kilograms of weed in 6 months, meaning possibly more in a year. 5,000 kilograms with Quebec, with Medreleaf having 8,000 kilograms a year in Quebec as well. They don't have agreements with British Columbia, Ontario, and a few other provinces yet, so they have a guaranteed 38,000 kilograms right now, which is less than Canopy at 67,000, not counting Ontario. Once all the provinces sign agreements, it's quite possible they go up to at least 65,000 kilograms a year, meaning they have less supplies guaranteed compared to Canopy, but it's only a 20 to 30% difference. Canopy can expect around 80,000 kilograms after Ontario. Like Canopy, they've partnered with an alcohol selling company called Liquor Stores NA. They will convert some of these alcohol stores to sell marijuana in the future. They bought a company from Germany called Padanios, the biggest weed distributor in Europe. This gives them huge opportunity in the European markets. There are 82 million people in Germany, more than double Canada, but only medical marijuana is legal right now. They want to provide medical marijuana to Germany, Italy, Denmark, Australia, Cayman Island, and South Africa. In the last quarter, they made $2.3 million from European sales, compared to $8.4 million in Canadian sales. That's about 27% going to foreign markets, but they had a supply shortage that will be fixed by next quarter, while Canopy has about 12% of revenue from foreign markets, meaning we could see at least 30% of their revenue coming from European medical markets, possibly a lot more in the future. A big difference between Aurora and Canopy is all Aurora facilities are GMP certified, meaning weed grown there are allowed to be sold in Europe. This isn't true for Canopy, which only has 500,000 square feet of GMP certified space. This could be a huge upside for Aurora if selling to European markets become a huge chunk of revenue in the future. Aurora seems to believe the European market is much bigger than the Canadian market, with Germany and Italy being big targets. This advantage could see revenues that more than double what the Canadian market brings in the future. Even Canopy believes the world market could be over $100 billion, compared to $5 to $10 billion for Canada, an important thing to keep in mind for Aurora. Canopy has a new 4.5 million square feet facility that will supply Latin America with marijuana. Canopy will likely expand into Europe in the future as well. Aurora also partnered with a huge drug store chain in Canada called Shoppers Drug Mart, as well as PharmaSave and PharmaChoice. They're also known for taking over other marijuana companies, recently Medreleaf for $2.5 billion, and before that, Canimed for over $1 billion. Since they're buying these companies with their own stocks, this leads to share dilution, meaning they're using their shares to buy new companies like Medreleaf. This leads to each share of stock being worth less. We saw the effect of this recently. It's down over 13% after the Medreleaf announcement, and they went from having 500,000 shares to over 900,000 as of right now. This means earnings per share and revenue per share will be lower, causing lower valuation numbers in the near future. Aurora is the aggressive one of the two, fast expansion at the cost of a lot of investor money. A quick summary on the important points. Both companies are very similar in terms of how much weed they can grow. Canopy can grow over 500,000 kilograms, Aurora can grow over 570,000 kilograms, very similar. Supply agreements determine an almost guaranteed revenue. Since Aurora has a 6-month agreement, here's how much they have for 6 months and 1 year. Canopy has 31,200 kilograms for 6 months, with 67,000 kilograms a year, possibly over 80,000 kilograms once Ontario comes in. Aurora has 31,500 kilograms for 6 months, with possibly 60 to 80,000 kilograms once all provinces and Medreleaf comes in. Right now Canopy has more guaranteed sales in the coming year. This could change very soon. Canopy has about $1 billion in cash to spend on growth. Aurora has about $500 million, less to grow with. Canopy has only 500,000 square feet of GMP certified space. Aurora has 5 million square feet of GMP certified space, a 1,000% upside if we're talking about supplying to Europe. Europe hasn't legalized recreational marijuana, only medical, but it's still a market that could be bigger than Canada in the future. Canopy has an area with more than 4.5 million square feet in Latin America, which could be competitive with European markets. Canopy is bigger and seems less risky, but Aurora is expanding at a much faster rate with their buyouts of other companies. Aurora reminds me of Amazon in their mass expansion. All these buyouts cost investors in the short term, because of diluted shares, but should pay off in the future just like Amazon. Canopy can make over $500 million a year in revenue, while Aurora might come in behind at $350 million to $400 million in the beginning. It depends a lot on how much Ontario agrees to buy from both companies, and how much Aurora might get to sell in the near future. It's really hard to tell how much revenue they can make right now, but these are minimum estimates. With revenue like this, their price-to-sales ratios will be a lot more fair at 15 to 20 range. At this rate of growth, if these companies can sell over 200,000 kilograms a year, which is less than half their capacity, we can see prices double from their current prices. This is with a price-to-sales ratio of 14, still very high. If they can sell over 400,000 kilograms a year, the stock can quadruple, or at the very least double if the price-to-sales was more reasonable at 7. This means both these stocks are playing the long game. The first few months after legalization in October will see higher revenue but not incredibly high. Once all facilities are complete, and supply agreements are higher, revenue will spike up like crazy. These are companies to hold for the long term if you decided to buy, until at least 2020. By their numbers, they're both extremely high risk and could see drops of 50% or more in the short term. I like both companies, both has their strengths and weaknesses. They're definitely the leaders of the marijuana field once legalization comes around. I'm not recommending you buy these companies, only presenting the facts. These could definitely lose you money if you don't do your own research first. Personally, I will be buying over $40,000 worth of both these companies. To see exactly how much I put in Canopy and Aurora, join my stock market group. You will get instant updates of my every move in the stock market, with live email updates and portfolio updates. I have over $230,000 in my stock portfolio, and it's all in the market. Recent winners include PayPal, 8.8% profit, Adobe, 7.3% profit, Best Buy, 8% profit, and AMD at 37% profit. Look in the description for a 50% off coupon. It lasts a lifetime, but it's only available until 300 members. It's hitting 300 in the next 2 days, so get in now. Subscribe and hit that bell for more weed stock videos. I make them on these huge growth stocks whenever possible, and leave a like if you learned something about marijuana. Keep watching to buy the best speculation stocks, the Monk way.